Okay, here we are for another last problem that we're going to do for chapter 11. This is another common current liability, and that is our interest payable. So we're going to go ahead and practice a more tricky problem with that. And so here we have on December 31st, Archer Spy Supplies purchased 13,000 of merchandise inventory on a 1 year 9% note payable, and they use the perpetual inventory system. Okay, so first transaction we want to do is just recording the purchase of the merchandise inventory with that note payable. So that is on December 31st. So let's go ahead and put in our date because that wasn't pre-written. And so we have received, Archer Spy Supplies received, they purchased merchandise. So they received some merchandise inventory. That's an asset. So that increases with a debit. Now we have it. We didn't have it before. So we'll increase our merchandise inventory account by 13,000. And so now they said they didn't pay cash for it. They owe it with a note. So we'll have a new liability called notes payable. All right, so that is it for that transaction. Not too bad, pretty simple there. Next we have is we're going to record that accrual. They want us to journalize the company's accrued interest on June 30th. Okay, so it's now the next year, 6 months have passed, right? So we went from December 31st of the previous year all the way to June 30th. So 6 months have passed. So there's some interest that they want us to record for that 6 months. It's its physical year end. And so they need to true up their records and record that 6 months worth of interest. So we have a formula that we can use. You probably learned this in a math class, and it was principal times rate times time. And that would give you your interest. Okay. So we have the principal of the note was 13,000. So we would say 13,000, right, for the principal. That's the P. And then we have the rate. Well, what's the rate? It's 9%. That 9% is for a whole year. We'll do 0.09, so it makes it easier for your calculator. That's 9% written as a decimal. And that rate is for, that interest rate is for a whole year's time. So if we just did 13,000 times 0.09, we would get the interest for a whole year. But we can see the problem here we want for June 30th, from December to June. And so we need 6 months worth. So how do we change that? I think we talked about this in previous videos and lectures. We would say, well, a whole year is 12 months. So whatever amount of months over 12, that would convert that to be for that portion. So I'm sorry, I apologize. I'm not a math teacher, so I'm sure some math teachers rolling their eyes the way I explained that. But that is principal times rate times time. We have 6 months out of the year that we want. You could cut it in half. You could say 13,000 times 0.09 divided by 2. That's easy for, since it's only 6 months worth. But let's just learn the time part of this formula. And if it was only for 3 months, it would be 3 over 12, right? And you would multiply that all out and you would get your portion of interest. Well, we want it for 6 months. All right, so let's go ahead and do that in the calculator. You know, you could have done, if you didn't know 6 divided by 12, right? You got the 1/2, the 0.5, right? So we can say, well, we can keep that there, the 0.5, times the 0.09, and then times 13,000. And, oh, I did something wrong. Hold on here. I was like, well, how did I get it? It was too small of a number. So what did I do wrong? I did 0.05, right? 6, I wrote it in wrong when I did my division. So 6 divided by 12. Come on, Debbie. 0.5, right? I wrote in 0.05. So ignore that 0.5, right? 1/2, 6 divided by 12. And then times 0.09. And then times, there we go. It's going to be my right number, 585. So that's my interest. So make sure you pay attention to your decimals and don't mess up like I did. Oh, there you go. Geez, come on. All right, let's scroll up a bit so we can write our journal entry in. And so this is for June 30th of the next year. And we have now used up 6 months worth of this note, of this time for this note. And so we get to record a cost associated with it, an expense. So we have interest expense that we get to record. So we get to have an expense related to our eventual sales of our inventory when we sell it. And then now we didn't pay it yet. Didn't say it was paid, it just accrued it. And so we need to record interest payable. All right, perfect. Our next journal entry is the payment of the note plus interest on December 31st. Okay, so now another 6 months have passed again. And so now we have the end from June 30th to December 31st. We have another 6 months of interest that we need to record. We already recorded the first 6 months of that 1 year note. That's here. So we don't want to double up on that. We already recorded an expense associated with it. So we're only going to get to record another interest expense just for the other half of the year. So it'd be the same formula in this case. It would still be our time, our principal times rate times time would still be 6 months out of 12, or a half, right? A half of the year. And so we still will have another interest expense for $585. So let's go ahead and we can record that since we were talking about that. You can go in different order. I mean, we're paying the notes payable as well. So I'll make a placeholder for that because I think your book likes to do it that way. And then we'll write our interest expense that I just spoke about. All right, so there's our additional 585. So we got the first 6 months and then now the next 6 months, okay? So that's that part. And then we have that note. We're now paying for the note. So they're making the payment of the note plus the interest. And so we had a note payable for 13,000. So we're going to do a debit for the notes payable for 13,000. So let's go ahead and record that. All right, so we can see what's going on there. And they're also paying this note payable here, what I just checked mark. We're also going to pay that. So we're going to record a debit for interest payable as well. And that just so happened to be the same amount because it was half a year each time that we recorded the accrual. Okay, and so those are all my debits. And what are we paying? We're paying cash. So we're going to have to add these all up, and that would be our total for cash. So we can just go ahead and do that. So we owe $14,170 for cash. So where students get tricked, where I see errors mostly happen, is they try again to record the interest expense for the full amount of the year. Well, remember, we recorded already an accrual for the first 6 months of that note already on June 30th. So we're not going to double up on that. We can't record more interest expense because we already recorded the half of the interest expense here. So only recording the other half from really July 1st to December 31st. Okay, so that was the area where most students get tricked up on that. So just remember, when you already record interest expense, don't double up on it. And that is it. It should be pretty simple from there for all the problems for this chapter of current liabilities. It's probably seems to be the more easier one. If this is not new to you, the principal times rate times time, you probably learned this in a business math class already. And if not, then this is probably where you need to just have more practice with. This was a nice problem because it had 6 months only, so it was easy division for that, but maybe it's 3 months, maybe it's 5 months that you're recording the accrual for. And so that might be where you need practice on the math. Okay, but that should be it for this problem. So good luck on the rest of the problems. This should be fairly easy.